Hello, today's Friday, November 28th, 2022. No, October 28th, 2022. I'm Jason Shapiro with CrowdedMarketReport.com. Today, I wanted to get into a little bit about macroeconomic analysis in the market and how people think about it. And in general, on a very general basis, people like to look at, obviously, economic growth and interest rates. The theory being economic growth leads to a positive stock market, negative economic growth leads to a negative stock market, and interest rates help as well. Lower interest rates can lead to a positive stock market and vice versa. And this is really what's dominating the thought process these days, as it does many days, because the argument is that this market has been going down because the Fed has been raising rates aggressively, and raising rates should cause a recession, which the market is discounting, and that once the Fed stops raising rates, we can go back to lower rates, higher economic growth, and a higher stock market. And that's sort of where we are in the market now, and you see it because as people are now starting to discount the fact that the Fed is close to stopping, the stock market is starting to run up. Okay, but what I'm here to tell you is that it's not really true that's the case, right? It might be true for short periods of time, as people try to play this, but if we look, and I'm going to give a few examples here. This right here, I hope we can see this clearly, but this right here is the Hang Seng Index, and this came to my attention this week because I paid pretty close attention to Hong Kong stock market just because it was where I first started trading, and so it's just old habit that I pay a lot of attention to it. As of this week, the Hang Seng Index is at the same place that it was in 1997. So you're looking at 25 years, okay? And this is the chart of that, right? In this particular chart, it says it's up 5%. If we had gone back another week or so, it would show flat. So let's just say the Hang Seng Index is flat from 1997. This orange line, okay, shows the GDP of Hong Kong in that time period. So in that time period, the GDP of Hong Kong is up 108%. So GDP has more than doubled. The stock market has gone nowhere, okay? Well, maybe it was interest rates. Well, this interest rates in Hong Kong are tied to the U.S. interest rates because the currencies are pegged. So interest rates in Hong Kong are lower now than they were in 1997. Okay, and you're talking about an economy in 97, Hong Kong was taken over by China. China was still a very small economic player because they hadn't built up yet, and they've gone to become the second largest economy in the planet in that period. So, and Hong Kong was supposed to be the main beneficiary of all that. So it had the infrastructure, it had the finance, and it had all the trade stuff, and it was going to be this incredible thing. And if you think about the fact that it was getting Chinese growth with the U.S. interest rates, this market should have gone up 50 times, right? If you had told me in 97 that China was going to go from where it was to be the second largest economy in the world, and that interest rates in Hong Kong in that period were going to be lower than they were in 97. And I told you the Hang Seng was at 16,000 at the time. Anybody with half a brain would have said the Hong Kong was going from 16,000 to 160,000. Well, it hasn't. It's gone from 16,000 to 16,000 in that time period. Okay, so that's just one example of that. Here's another one. Okay, this is Japan. Okay, the Japanese stock market topped in 1989. That's right here, okay? And since then, since the top of 1989, it's down 30%. And obviously it was down a lot more than that, but it's rebounded. It was down like 70-something% at one point, but it's still down 30% from 1989. That's 30-something years, right? And here's the GDP of Japan in that time period, okay? Which is up 60%. So GDP is up 60%, stock market is down 30%. Interest rates in that time period have gone to zero, okay? And they've been at zero for a very, very long time. I mean, this is sort of a famous thing. Interest rates in Japan have gone straight down to zero and have basically stayed at zero forever. GDP has gone up 60%. Nikkei's down 30%. So if you're going to try and tie GDP and interest rates to the performance of the stock market, you're missing a big part of things, right? And so let's say, well, the U.S. is not, the U.S. is not Japan, the U.S. is not Hong Kong, we're the U.S. and we're different, right? Well, this is the U.S. from 68 to 78, so this is a 10-year period. Stock market was exactly flat. I've got it down 3% for this 10-year period, okay? Interest rates were flat, okay? They went down, they went up, but they were essentially ended at the same place as they were 10 years earlier. And GDP in that period was up 94%. GDP up 94%, interest rates unchanged, the stock market flat. So again, this is not a short period of time, this is 10 years, right? And there's more examples of this too. You can go back, in the 30s and 40s and where the market went nowhere. You can even go back to from 2000 to 2013 where the market went nowhere and GDP grew. There's a number of these examples, I'm just giving one. But the main thing I'm saying here is that people are focusing on this. And if they really look at it, they're focusing on something that is essentially irrelevant. There's so many more things that matter than just the underlying number because, as I talk about quite often, the market is a discounting mechanism, right? So if it's over discounted, the fact that things are going to grow, like if the Dow Jones is at 400,000 tomorrow, then would it matter if the GDP grew at 5% a year every year for the next 20 years? There's that discounting issue, and I'm a big believer that we have over discounted starting in 21. We over discounted everything because of the amount of money that poured into the stock market, that we've over discounted, and therefore the returns, no matter what GDP growth is going to be, no matter what the Fed does with interest rates, the stock market is not going to offer very good returns. Not to say it won't go up and down, it all goes up and down all the time, right? There's rips, there's drops, but trying to correlate that to your forecast of GDP and your forecast of interest rates, as we can see here, is a complete waste of effort. So, just something I wanted to point out. I hope that makes sense to people. Always happy to take questions or comments. And again, if you like this stuff, please subscribe to our YouTube page. And if you really like it and you want more about positioning and a lot of other different trading ideas and a lot of things like this and a lot of commitment to trader stuff, please subscribe to us at crowdedmarketreport.com. All right, thank you, and have a good week.